Is this really about sort of year-on-year comparisons, or is this the fear of higher rates, or what do you think is the overriding dynamic?
It's been a wild one, Carl. Great to be back. And yes, you wake up this morning, DocuSign down 40%, basically pulled the entire sector down with it. I go through my entire screen, and the only green I see is Smartsheet out of about the 58 cloud names. It's been brutal. And this is a roller coaster week where we had, AWS's reInvent. Many of us were out there with Adam and team this week. Rah, big hopes for the future. You're flying home. Salesforce boots their projections, takes the entire industry down with them. Yesterday, you've got this separation where you have Snowflake crushing their numbers, you have Okta crushing their numbers, and then you have a handful, C3i, Elastic, and a couple others get pounded 10% plus, and then DocuSign last night. And so you can look at four causes. You can look at Omicron, you can look at inflation, you can look at interest rates, and you can look at profit taking. And I've got strong views, but I don't buy the Omicron or inflation elements in this case.
You don't? Because you don't believe the Fed will be aggressive, or why? Why not?
Well, Omicron is actually a counter indicator. As a reminder, working from home is actually very good for cloud stocks. And so this idea that the distributed economy is a net negative, I don't buy. And in fact, you saw the index was the #1 performing index on the entire NASDAQ last year because of this cloud accelerant. Now, inflation indirectly or directly isn't a cause because tech is naturally deflationary at its core, given supply chain benefits, and you don't have the raw materials inputs that you do in other industries. However, the linkage downstream to inflation certainly could cause a rotation to value stocks and cash generative stocks over time. And I think that's what we're looking at. However, I think the biggest cause here is simply profit taking. When people have been looking at these multiples, they're getting anxious, and you rotate from fear to greed very quickly and then back again to fear overnight last night. I think people are looking at their books at the end of the year. They're looking at these multiples and they're saying, I'm going to optimize for short term versus long term. There's no doubt that long term, these names are strong. They're going to be growers. They're leading the new economy. But over the next few weeks, buckle up, folks, because it's going to be bumpy.
Well, so Byron, looking at some of those valuations and also the recent results from companies like Snowflake, which of these companies is best positioned going into next year?
So I think the shocking thing about this is there's no obvious correlation. We've seen now infrastructure and apps. We've seen large and small. We've seen horizontal and vertical really separate with the haves and have-nots. And so the short-term trades, I think you're probably seeing overreaction both ways. I'm excited that you're going to have Dan at DocuSign on later today. They're down 40%. I strongly suspect that's an overreaction, but let's hear what he has to say. I think right now people go to the long-term view. You look for total addressable market. You look for pricing power with lock-in incumbents. You look for the long-term margin leverage, and you look for the bold teams that are going to give you a multi-year horizon. If you're looking for short-term trades, frankly, this may not be your sector because this volatility is likely to remain for the coming weeks.